Hello to everyone. Today I am here with anti-money laundering part 5. If you are interested to have more videos on banking and finance related topics, please do subscribe my channel. Anti-money laundering risk-based approach. In this session, we will cover introduction to risk-based approach, key risk factors, key risk indicators, client risk assessment. A risk-based approach aims to make our business systems as effective as possible at deterring money laundering and terror financing. It provides the base for the Money Laundering Regulation 2007, Act 2010, 7F, or can be the Act according to your own country. Risk assessment depend on the following. How big is the entity? Which type of client does it work with? Which area is it active in? What is the life of the business? So these are very important factors that you should consider while developing the relation with the customer. Key risk factor: corruption, drug trafficking, smuggling, including human smuggling, tax evasion. So these are the key risk factors. Risk indicators. Indicators of risk do not mean that a client is guilty of money laundering, but one should be aware of possibilities. Complex financial and property transactions. Assisting in setting up trust. When we use the word is complex financial and property transaction, usually it involves multiple transactions between the multiple entities or the people. So it make it complex. This can shadow how own the money, making and receiving payment in cash, transaction across borders. Assess client risk. Business understand the risk that working with a client involvement, the effective control may decide internally. The business should consider, is the customer in high risk category? Does the CDD material allow the company to verify the customer's identification? Is there enough information available about the client's ownership structure? Does the work in an area of law at high risk of money laundering and terror financing? Does the client ask the business to handle funds without an underlying legal transaction? Example of controlling risk. If the entity considers the client low risk but is unsure about their identity, it might be appropriate to use more resources to verify it. So identification is one of the very important factors that you should know the customer. If the entity is considered the client high risk but is sure of the identity, they might choose to use more resources to monitor the client's transaction. It means if a customer is low risk but identity is not confirmed, so you needed more resources to verify it. If the customer is known to you but the transaction is high risk, so in that case, you should be more vigilant towards the transaction. Thank you very much. See you again with upcoming video on anti-money laundering very soon.